Look at this chart. It shows us how traders are positioning themselves on Ethereum, whether they're betting on it to rise or fall. Green means traders are going net long, so expecting more upside, and red tells us that they are going net short in anticipation of downside. Now look at what traders are doing today. This is the most extreme short positioning we've seen since March of 2022. In other words, a record number of traders are now betting that Ethereum's price is going to decline from here. The last time we saw anything similar was right here in March of 2025. And if we look at what Ethereum did after that, it rallied over 100% from something called a short squeeze. That's when too many traders bet on an asset to decline, but the price starts rising instead. This forces those traders to buy back Ethereum to close their positions, which only drives prices even higher. That's what happened in this rally. Rather than driving away the bearish traders, the recent short squeeze appears to have only strengthened their conviction as they doubled down on their bets. After all, Ethereum has been one of the biggest pain trades of this entire crypto bull market. It's still down about 25% from its previous all-time highs. Traders are betting that this underperformance in Ethereum is not going to stop anytime soon. And this is happening despite it now being a year since Ethereum ETFs have listed on the stock market, a development that many believed would mark a major turning point for Ethereum's demand. Instead, today, the average Ethereum ETF investor is sitting on almost a break-even. By tracking the price of Ethereum and the volume of daily flows into these ETFs, we can reverse engineer a rough estimate of what this group of investors actually paid on average. This line here represents that estimated entry price over time. Right now, the average Ethereum ETF holder has entered around $3,500. So back in April of 2025, when Ethereum declined to about $1,400, the average investor was looking at an unrealized loss of nearly 60%. Those kinds of losses can often create psychological pressure that can lead to capitulation, especially among newer or weaker hands who have been sitting on losses for weeks or months and finally decide to throw in the towel. And we can see exactly how this drawdown impacted investor behavior by replacing the line showing the average Ethereum ETF investor's entry price to these bars, showing the total Ethereum ETF outflows, or in other words, the selling pressure on Ethereum ETFs. Once Ethereum's price fell below the average entry price of $3,500 in January 2025, we can see that there was a big acceleration in the outflows from the Ethereum ETFs. That tells us a lot of investors who were in the red began to capitulate, locking in their losses and exiting their positions. So it's been a painful ride for many of these Ethereum investors, what Warren Buffett would call a blood in the streets kind of environment. But historically, when there's widespread pain in an asset, it's often presented investors with some of the best opportunities, and there are already early signs that the worst of the selling pressure may already be behind us, because since March 2025, the outflow trend has actually been declining. In fact, in the past month, we've only seen a handful of days with net outflows, while most other days have actually seen net inflows. And this development has been happening alongside Ethereum recently, being very attractive from a valuation standpoint. One of the clearest ways to see that is through this chart, showing us something called the realized price. This calculates the average price at which all circulating Ethereum was last moved on-chain. In other words, it gives us a rough estimate of the average entry price for every Ethereum holder based on actual blockchain transactions. We use this to gauge whether the market is broadly in profit or loss. When Ethereum trades well above its realized price, most holders are sitting on big gains. But when price dips close to or below the realized price, it usually indicates capitulation in the Ethereum market. And historically, those moments of pain have coincided with some of the most attractive long-term buying opportunities. We saw that occur in January 2019, again in March 2020, in July 2022, and in January 2023. Each of these instances saw Ethereum trading right around its realized price, and each one marked a period where demand began stepping in and bidding prices higher. In fact, this is exactly what we're likely seeing play out today as well, as Ethereum recently reached its realized price, attracting buyers that have led to a 60% rally. In fact, there's an even more comprehensive way to evaluate Ethereum's valuation. Rather than just looking at the realized price in isolation, we can compare it directly to Ethereum's market value. Here's what that chart looks like. This ratio gives us a broader view of investor sentiment and profitability across the Ethereum network by measuring how far the current price has moved above or below the average investor's entry price. In simple terms, it tells us how much unrealized profit or loss is present in the system. When this ratio rises above 2, it means that the average Ethereum holder is sitting on more than double their money. This has historically been a sign that the market may be getting overvalued and is at risk of a pullback. And when the ratio drops below 1, it tells us that Ethereum's price has fallen below the average price that investors paid, indicating widespread losses and a potential undervaluation zone. Since the start of this bull market in 2023, the highest reading we've seen on this valuation metric came in March of 2024, when Ethereum hit $4,000. At that point, the ratio peaked at 2.35, meaning the average Ethereum holder was sitting on an unrealized gain of about 135%. Even though that was a strong profit margin, it was well below the euphoric levels seen in previous bull markets. In the 2021 bull run, for example, this ratio climbed all the way to 3.8, and during the peak of the 2017 bull market, it reached as high as 6.5. So, we still haven't seen extremely overextended valuations for Ethereum in this bull run. But in order to run up valuations, what Ethereum actually needs right now is a real driver of demand. In other words, a fundamental catalyst that can convert undervaluation into upside. And that's also something we saw happen in the past as well. In 2016 and 2017, smart contracts and initial coin offerings allowed developers to build on Ethereum and increase the demand for the coin. And in 2020, the explosion of decentralized finance created a surge in usage and capital inflows for Ethereum. Each of those moments had one thing in common: a clear fundamental catalyst. And for most of the current cycle, that's been missing, at least until very recently. Believe it or not, a new potential catalyst may finally be emerging for Ethereum, and it's something we also touched on in our last Ethereum video. It's called the Genius Act, a piece of legislation in the US aimed at bringing regulatory clarity to stablecoins. This matters for Ethereum because over $130 billion worth of stablecoins are built directly on the Ethereum network. So, out of the roughly $240 billion total stablecoin supply, Ethereum hosts more than half, making it the largest infrastructure blockchain for stablecoins. And this dominance becomes clear when we look at this chart showing the distribution of stablecoins across different blockchains. Ethereum currently holds about 60% of all stablecoins in circulation. The next closest competitor is Tron, and even then, it holds less than half of what Ethereum does. With the Genius Act aiming to establish a regulatory framework for stablecoin issuance, the overall market is expected to grow significantly in the coming years. According to U.S. Treasury Secretary Scott Bessent, the stablecoin market is projected to reach $3.7 trillion by 2030. From current levels, that would be over a 1,500% growth in the next 5 years. And because Ethereum is already the leading infrastructure for stablecoins, it's uniquely positioned to capture a large portion of that growth. More stablecoin activity means more transactions, more fees, and more demand for Ethereum, which translates into more demand for the Ethereum coin itself. So, if stablecoins become more widely adopted under clear regulation, Ethereum potentially stands to benefit both in usage and in valuation. However, one short-term overhanging risk to all of this is the uncertainty around the upcoming tariffs that could go into effect starting August 1st. Trump has already started sending out the official tariff notices, and if any part of this process surprises the market, it could lead to a short-term sell-off in risk assets like Ethereum. But given that a deal is already in place with China, which posed the biggest risk of escalation, the risk of a major market shock appears quite low. Regardless of how the tariff situation unfolds, though, it doesn't change the fundamental development that's occurred, from which Ethereum could see a significant increase in its demand, potentially leading to another short squeeze. This, in our opinion, could provide the necessary momentum for Ethereum to finally break through this critical $4,000 resistance level that's held it back from making new all-time highs this bull run. We're closely watching Ethereum today for another attractive risk-reward entry point. And just like with all of our trades, we have a clear risk management framework for the crypto market. Our approach has delivered some exceptional returns in the past year, like 30% on Bitcoin, 63% on Solana, and even 83% on Ethereum. And more importantly, we've kept most of our losses to under 5%. If you want to follow our strategy step by step with real-time buy alerts, sell signals, and portfolio updates, then make sure to subscribe to our service.